Wall Street is clocked out, and we are clocking in to bring you the latest headlines. The closing bell just rang, and the Dow ended the day in the red. So stocks slid on the new data showing the U.S. economy shrank. So here is your headline. The gross domestic product, or GDP, declined at a 0.3% rate in the first quarter of 2025. So if we go over to our interactive stock market heat map, this is brought to you by FinViz. It shows the top 500 stocks. As you can see, a good amount of red today. CBS News MoneyWatch correspondent Kelly O'Grady joining us now. Hi, Kelly. Let's start first things first. Why don't you break down what the GDP is and why it is so significant?
So it's significant because it essentially tells you how the U.S. economy is doing. You know, is it growing? Is it declining? You probably heard a lot today that this is the first quarter in a very long time where we've seen contraction. Now, the technical definition of GDP is the total market value of final goods and services produced within the U.S. in the year. And then just to kind of give you a sense of what those things are, I mean, goods, this is things that people make, they grow, they extract from the land. So it might be a car, an apple, you know, a gold ring, things that are made here. And then services are things that people do. So think of your hairstylist, you know, your bus driver, your doctor. Those are services. And then the market value is how much something costs in the marketplace. So what you pay for that apple or that car or for your haircut. And the way that you think about it is that that is all of the economic activity that happens in the U.S. And so when that is booming, when that is growing, when a lot of things are being produced here, sold to other countries, that is a positive thing. But this time around, that wasn't the case. And you can see on the screen right there, normally over the past few quarters, it's been 2 to 3% growth per quarter. So the fact that this came in negative, Jules, was a big deal.
So does uncertainty then drive the GDP to decline?
So what's driving GDP to decline? It's sort of uncertainty. So a number of things go into GDP in terms of how they calculate it. One is imports. And basically that skyrocketed this time around. There was a over 40% surge in imports. And what that was is businesses and consumers getting all of those foreign goods into the country before those tariffs hit, before you see price increases for those goods. So kind of, yes, you know, you said uncertainty, does that drive it? That did this time around drive people to import more. And so that's really what's driving the drag on GDP, that negative number. I will note, when you strip out imports, when you strip out exports, kind of all of that tariff noise, the underlying growth, we call it core GDP, that actually grew 3%. So yes, the headline, I think for a lot of people was scary today. We never like to see contraction, but the underlying data still shows that we're in a good place once you strip out that tariff noise. But Jules, it's very hard to strip out the tariffs because that is a looming thing that everyone is very worried about.
Good explanation. Okay, so the numbers really aren't as bad as we're talking about. Inflation data came in a little better than expected. So what is going on there?
Yeah, so this was a bright spot today, and I actually think that's exactly why you saw the market start off more in the red, but finish still in the red, but not certainly off session lows. So PCE inflation, that is the Fed's preferred gauge for inflation, that came in cooler than expected. We saw a 2.7% increase on an annual basis last month. And this came in at 2.3%. So we're getting closer to that 2% target. What this tells all of us and all these economists and the Fed is that the underlying inflation trend is good. The wild card is going to be tariffs, though. What happens when companies start flowing those price increases through to you and me? So that's what we're watching for in the future, Jules.
All right, Kelly O'Grady. Kelly, thank you.